Well, there's usually music. There's usually the drum beat. What happened?
Drumming's not there. I think as we started a little late, there's no drum.
Okay, that's fine. No drums, but it's caught me off guard here. Welcome to Tradiers, the Trader's Edge. I am Jim Iuorio. That's Bob Iaccino. But this is my favorite show to do because it's live and because it's easy for you guys to submit questions and comments. We love that. We're going to have a great guest we'll introduce in a second. Which, by the way, so here's what I'm getting fed up with, and I've written about this quite a bit. So is there a chance that today Donald Trump floats out, or the White House in general, whatever it is, floats out, yeah, firing Jerome Powell? Then all of a sudden, bonds take it on the chin, dollar takes it on the chin, stock takes it on the chin. Literally 30 minutes later, it comes out, no, I didn't. That's not what I said. I said I'm looking into it. Are you starting to get, and I think Donald Trump's done a lot of good things. Are you starting to get irritated with the things he does that are market volatility inducing that don't go anywhere?
So I don't know if the client that I did this for appreciates it or not, but I did sort of a midday update for a client today. And I put in there, and this was after the New York Times had reported on it, and then others picked up on it. And then after Trump had said, no, that's not what I said. I don't know. I don't know of any letter. Of course there was a letter. Right?
Yes.
He was asking for advice. That's fine.
Yeah.
I've basically worded it as Trump's going to get his rate cut one way or the other. Yeah. That's how I look at it. He's either going to put so much pressure on this guy to where he either resigns, cuts rates, or he just rides it out. And then Trump continues to blame him if things get worse, if he's not able to get rates lower like him and Besson both want, which that's not happening in the 10-year right now, right? Yeah. So the 10-year pop up after that sort of debacle. We saw the yield curve steepen. So I just think it's Trump saying, I'm getting my rate cut one way or the other. I'm going to pressure it, or I'm going to make you resign, or I'm going to find out if I can fire you.
You know what? Okay. And I hate the fact that I kind of agree with Donald Trump that rates should be lowered. But here's the way, if you and I were Fed chairman right now, I would want a 25 basis point cut, the next meeting, the next available meeting, and then watch closely what the 10-year does. Because last time he cut 50 basis points, 10-year yield screamed higher, meaning the market was screaming at Powell, you did this too early. If nothing happens, that'll be more of a green light to ease more. And I do think that inflation is relatively under control. Does that make sense?
Yeah, it makes a ton of sense. I mean, I believe me, I think they should cut too, because I think, as you know, I'm against the crowd. I don't think tariffs are inflationary. I think they're deflationary, and we can go into that. And I actually had a fun argument with Perplexity, one of the AIs that I use, where I went back and forth, and I actually finally got it to admit, you're right. The way that you've worded it means that it's a whole, I don't want to get too deep.
I love arguing with AI, to be clear, though.
Yeah, it's just, I think they're deflationary, and I really do think that we need a rate cut, but only because of the actions taken by the Trump administration. Otherwise, I think we were pretty solid, and we could have hung here for a while.
So we are going to bring on the guests. And one thing, I've said this a million times, you can think Bobby and I are full of shit, but you cannot deny that we get great guests. This guest is particularly special to us because Larry Kudlow 2 weeks ago said to me, because I was pessimistic about something, and he said, you know what? I like my interest rate guys to be a bit pessimistic. And that's true. Interest rate guys, for some odd reason, equity guys are optimistic. They think things are going higher. Rate guys are oftentimes pessimistic, and I can't explain why. But we are bringing on one of our favorite guests, Ryan Dietrich, who is the chief market strategist of the Carson Group, and who Bobby likes to call Mr. Brightsides, because every time we think all hell is breaking loose, Ryan comes on and says, relax, here's what I think is going to happen. And he's usually right. Let's bring on Ryan Dietrich. There's my drums. Where they weren't there the first time. It made me look like a damn amateur.
If we ever become a professional show, we'll actually have a theme song for every person, and the song will start playing.
Oh, that's
we all know what this one would be.
Yes, we do indeed. How are you, Ryan? Good to see you.
I'm doing well, guys. Thank you for having me back. Interesting conversation to start things off. Will he or won't he fire Jerome Powell? Can he even do it? It's crazy. There's so much to talk about, but thanks for having me back.
I was going to ask you dogs or cat, peaches or mountains, but since you got right to the meat, I am interested in this. is I have no idea who you would vote for. Know what I venture to ask? I don't like anyone can ask me and I'll tell them I don't give a shit. I am getting a little irritated with the things he said that induces volatility. I think here's what I think. I think that it's completely inappropriate coming from the highest office in the land. I also think that occasional volatility bombs may keep people from digging in their heels short to medium term and make for a more durable, longer term market. Do you have any comments on that?
Yeah, man, you're working, you're doing your day, and you hear President Trump might fire him again, and then the market sold off, like you said. And it's, oh no, I didn't say that. I mean, I think that was floated, obviously, for a reason, probably. And I'm with you. I mean,
wait, time out. You're saying that what I think too is that there might have been some sinister, like, oh shit, dollar and bonds are crashing. I didn't say that. That's what you're saying.
Yeah, I mean, I don't know, crashing today, but they obviously did what they did. And you're right. I think it is they float these things out sometime. I don't know if it's totally sinister, but maybe just see what happens. And then, well, we can fix it in a hurry. But I said, no, that's not the case. And yet he's been pretty much bashing him on all over social media. So, they're not buddies. I don't know if they're going to share holiday cards coming up here. But, the reality is this is something that we talked about back in April on the Carson Investor Research team. Working with a guy named Sonu Varghese, real good friend of mine, smart guy. He said, back in April, they can't just fire him. They have to find cause, right? Now, what is cause? And this is way above my pay grade. But obviously, they're going the fact that they're spending $2.5 billion fixing up the Fed. I jokingly said, I wonder if they're going to have like a retractable roof. Like every time I hear $2.5 billion, it's a stadium that has a retractable roof. Wouldn't it be cool if the Fed said, let's open the roof today before we cut interest rates? I don't know. Maybe that's worth $2.5 billion. But the reality is that's the way they're going. It is something. I mean, the other thing you think about, though, is, well, who gets to pick the next Fed chairperson? Oh, that's right. The President of the United States. So next May, when Powell leaves, I mean, we know President Trump's going to get a dove in there. So, part of me wonders if the market's just going to sniff out whether it happens next week, tomorrow, or May of next year. There's some reasons to think that. Then the other reason, you layer on top the inflation data. I mean, there's pockets, furniture costs more, toys cost more, apparel costs more. Well, that's the pockets of inflation we get because of tariffs. We understand that. But at the same time, as I came on with you guys probably for 2 years now, and I know a lot of guests have said this, shelter. It's 44% of core CPI. Shelter's finally coming back. So you got some part of inflation higher, some part coming back. Maybe it's kind of a wash in a way, and that opens the door again. But it's at least it's giving us something to talk about when we do our podcasts and videos, if nothing else.
I want to go right into some of the viewer questions, Ryan, because we usually get a string of them with you. And I don't want to get behind here. I've got some of my own questions. But first of all, Steve Goldstraw says cut 25 basis points, then watch the 10-year. I assume Steven means it's going to go higher. And then Dan Kozel said, these guys are not full of shit. Can confirm. Happy to see that. Come on.
Thank you, Danny. That's nice of you to say.
Biggest compliment we've had all day.
But then Tim, who's a regular watcher of the show and a friend of both Jim and mine on a personal level, if we get a 50 basis point rate cut, does the 10-year move up or down? I assume he means in price.
Yeah, that's what I want to know, Tim. That's what I said earlier. If we were the Fed chairs right now, drop by 25 basis points because inflation has shown that it's not really picking up, and look at the 10-year. If the 10-year thinks that that's an inflationary move, it'll tell you. James Carville always said he wants to come back as the bond market because the bond market is the only thing that scares the hell out of everybody. That could easily happen.
I have a view on this question, but I want Ryan to give his first.
Yeah. Boy, whatever I say, it'll probably do the opposite, I guess. I mean, the reality, I think, is if the Fed cuts and they say the economy is weakening, that might mean you get a little bit lower rates. But maybe they cut once or twice and rates stay high. I mean, the other side of all this stuff, all the deficits that we have, all the spending that we have, the one big beautiful bill, there's a lot of positives there, but you can argue there's some negatives to it. What we've been saying the whole time, we thought rates would stay a little higher. Back in 23 and 24, we've always had an overweight to equities, as you know, underweight to bonds, because we want the economy be a little better, maybe rates are a little bit higher. When you have a deficit of about 6.5% right now of GDP in the United States, it's going to go to probably 8% the next year and a half. Look back in history. We've never seen a period where you have an economic expansion with deficits that much of GDP. During a recession or 100-year pandemic, yeah, sure you do. But this is more normal time. What are the four most dangerous words? This time is different. Sir John Templeton. But the thing we know historically, a large part of deficits is GDP. You tend to have more corporate profits. You tend to have a stronger stock market. I mean, the strongest stock market in the world since October 2023 just about has been Israel. They've got a lot of stuff going on there, but they also finance a lot of with the war, have some deficits, and that stock market's done well. Last comment here, when did our stock market bottom after the 3-year bear market during the tech bubble? March of 2003. What happened back then? The war in Iraq started. We started spending a lot more money, having big deficits for several years. And the funny thing about it, big deficits can be a positive, but you got to pay the piper somewhere. And it's probably higher, or at least not necessarily massively higher interest rates, but high interest rates don't want to go down. Let me put it that way.
So you're saying because of just the massive supply to finance our debt and deficits, rates are going to stay higher. That's what you're saying, right?
We think so. Now, maybe the Fed does cut 2 times. I mean, let's be honest. Maybe they cut, 25 basis points twice. That's not a lot. You look at incomes right now, not incomes, wages, 3.1%. Well, they were 3.1% in 2019. Fed funds then was 1.5%. Now it's 4.5%, as we all know. I mean, we've been in this the camp all year back in January, February, March, and the Fed should be cutting. Well, they didn't. Now they've kind of missed their window in a way, because the truth, again, is you look at inflation, everybody's been saying this, with tariffs, you're going to have a little bit higher inflation coming, probably in September and October.
Not everybody's been saying it.
What's
not
that?
Not everybody's been saying it.
No, not everybody, but I mean, we'll see. But I mean, I think the thing is, so many people have been wrong because it's more delayed. It's going to be more delayed. Okay. It might come more in the fall, is what we think, and that's what Powell knows, and that's why he's being a little leery. But the reality is, the good news. We'll talk about some negative stuff. I still think we're in a bull market. I mean, higher rates aren't the end of the world. The Fed cut 100 basis points or 150 basis points. I don't think that'd be a good thing for the stock market, because it probably means our economy is slowing down. And you look at the inflation, one thing on this, CPI, right, down 3 months in a row on hotel prices, down 3 months in a row. Maybe it's rental cars, something along those lines, something along the lines of service, air tickets. You're seeing some softness in the economy. Doesn't mean the economy has to go to a recession. We think the economy is slowing the second half of this year, maybe just a mid-cycle slowdown kind of, and continue to go forward. But those are some things to think about. And again, probably why the Fed should cut, but doesn't mean they're gonna.
I'm gonna go ahead and comment on this, and you guys can tell me I'm nuts. I think the 10-year.
Oh, yeah, I was supposed to hear what you said first. Okay, sorry.
I think the 10-year price drops, the yield increases if we get a 50. First of all, I don't expect a 50 basis point rate cut. Right. But if we get that, I think the 10-year yield screams and the price drops. And here's why. First of all, we saw an example of it today. Right. We saw a shift in the curve. As a matter of fact, the 5s 30s went from like 93 to 118, 5s 30 spread, which is a steepening. And then it came back a little bit, obviously. And the reason I think that is because I think tariffs are not inflationary. They're deflationary unless they are continually rising tariffs. This is the argument I had with Perplexity AI today, where it said tariffs were inflationary, but they're also slowing the economy. I'm like, you told me a week ago tariffs are a tax. Well, they are a tax. Well, taxes are deflationary, right? Because they hurt demand. Well, yeah, but if it ends up being a problem in the supply side of things, well, then they're not inflationary. Because if companies are not passing the tariffs along to the consumers, then they're not inflationary, right? So you can't call them inflationary and call them a tax. You have to pick one. I pick tax. And one of the things I took from that argument, which I won, is that tariffs can be a problem if they're not offset by something. And if they're offset by tax cuts, we didn't get that. We got taxes status quo. That's one of the things that one of the rhetoric, semantic tricks the Trump administration is doing, saying we had the biggest tax cut. No, you had the biggest tax maintained. You didn't have a tax cut, right? Yeah. But there were a lot of people and a lot of institutions planning for those to expire, and with their fingers crossed that they wouldn't expire. What we have, if we get a rate cut, is we have an offset to the slowing of the tariffs. And we're still above the inflation target of the Fed. So I think it becomes very inflationary, and the 10-year reflects that if we get a rate cut right now.
So I'll chime in just real quickly. If you remember last September 19th last year is when the Fed cut. The only reason I remember that is my son's birthday. It's also Talk Like a Pirate Day, but that's when the Fed cut the first time. They cut one more time. And I mean, I don't need to tell everybody this, but sometimes it's just good to remember. What did rates do the second half of last year? Really, the second they started cutting, went straight up. I mean, rates and yields went straight up when they started cutting, kind of confusing a lot of people. But Bobby, what you just said, maybe that could be the case again.
Yeah, but you guys, I think we're We're like, if we were the Fed right now and we saw those crappy unemployment numbers and inflation relatively tame now, there doesn't seem to be a lot of harm in cutting 25 basis points and then watching what the 10-year does. The 10-year is not going to fall completely out of bed because of a 25 basis point cut. But if we see it start to fall out of bed, then okay, that was the wrong idea. That's what he should be doing, in my opinion. Let's talk about the thrust that from those April 18th lows. And I want you to put this in some sort of historical context.
Sure.
Because the first 20 days after April 8th, Mike Singleton of Invictus Research was talking about that level of thrust usually leads to, and then he filled it in. I want you to tell us what you think it usually leads to.
Yeah, there's a lot of angles on this. Hit rewind just for a second. So we had the near bear market on May 2nd. I'm just looking at some old notes. On May 2nd, Barron's had their big money pull. And I'll be very clear. I love Barron's. I read it every week. And I think Barron's has been more right than a lot of other magazines. Look at you, economist. But the reality, they had their Barron's big money pull. They interviewed like 50 big money managers. The most bearish these money managers had been in the Barron's Big Money poll in history, going back 30 years. They literally had a cover on May 2nd that showed this lonely little bull off by himself in his big field and said, where'd all the bulls go? We just gained more than 11% on the S&P the month of May and the month of June combined, the largest 2-month rally in those 2 months ever. So that's kind of some context about this. But so to answer it, April 8th was the low. We just finished the other day or so, 3 months off those lows. I think last Thursday. S&P up 26% in 3 months. You go back in history, like I like to do, 5 times. We've seen a 3-month, we've seen a 3-month rally like that. Now, here are the times. These might sound familiar to some long-term investors. Off the lows in 75, off the lows in 82, off the lows in 2009, off the lows in 2020, and then you had a January 99 in there. Yeah, I know it was near the end, but we still have 18 more months of the S&P and Dow going higher. 1 year after those 5 times, you're up at least 25% in 3 months. Okay, so already up 25%, like a ball under the water, let it go, it starts going, gets a lot of momentum, up 21% on average, up double digits every single time. Yeah, I get it, small sample size, 5, but there's lots of other things to be bullish about. I think that buying thrust that we've seen, I was talking about this 1 month off the lows, 2 months off the lows. Honest to goodness, April 9th, we saw a day with like 99% of all the volume on the NYSE higher, one of the highest ever. I looked and said, that's the low. Like, that's the low. You still want to see one more good day. Then April 21st, less than two weeks later, which is within 2 weeks, another day like 97 or 96% all volume higher. I looked, and that's when we started saying in our shop, the lows are in. I mean, people hated that call. It wasn't very popular, whatever. But, when you have those 2 buying thrusts like that, Jimmy, along with some of the other things, I know you've had the other guests, the Zweig breadth thrust, and we had 3 days in a row of up 1.5% on the S&P. All these things in middle to late April were saying, get ready, buckle up. This market wants to go higher. We know the headlines. We know the fear. We get all the stuff out there. But, I mean, I know on this, your listeners and the way we all were brought up, we listen to what the market's telling us. It told us we want to go higher. And honest to goodness, I still think it's in that camp, but we're still pretty optimistic. One final comment. We can talk a little more. The second half of July is kind of a choppy month. Yeah, July's up 10 years in a row. Literally, everybody's talked about it. I've been out there talking about it. Everybody gets it. But the reality, second half of July could be a little choppy, a little sideways. That'd be normal. That'd be fine. But I think we're going to continue. As bad as last August was with the yen carry trade unwind, it came out of nowhere and smacked us with a 2x4 on the head. We still gained 4% last August. Okay, just think about that. Think how scary the start of August was. So I don't think the summer rally is over. Maybe a little break, but that's okay. We're still bullish.
So to clarify something you said when
I don't know.
Right, exactly. Let's go back. There's a lot of shit. Yeah, so you said in a 3-month move like we've had, the comps on that, the last 5 from today, from the end of the 3 months in a year from now, we're up 21%. That's what you said.
21% on average. And again, 75 lows, 82 lows, 2009 lows, 2020 lows. I mean, gee whiz. You kidding me?
So tell me, is there in your head, can you concoct any fundamental reason for the middle of July being some sort of inflection point in the last 2 weeks of July being not good? Is there anything you think of? Not that we need that,
you've got the holiday. You got, actually. I mean, you've got the holiday. Historically, around holidays, markets do better. Like the strongest day of the year is December 26th. I don't think that's a coincidence because a lot of people aren't doing much and the market's usually closed. So tends to be high. Also, don't forget earnings season starts in late July. So you got light volume, got earnings. Maybe market kind of does a little potential pivot if we will. But I think it's just a lot of vacations and holidays. You're up a little bit, but all in all, I mean, I get it. You can talk about these things, and sometimes they work. Sometimes, believe me, I know sometimes they don't. But I will put it this way: what did we know coming into this year? Okay, 20% 2 years in a row. We were bullish. I know you guys were bullish. We talked about it. The first quarter after a 20% gain, usually not that great. The first quarter, the last 20 years, by far the worst quarter. Oh, by the way, the first quarter of a post-election year, you look at 16 quarters of a 4-year presidential cycle, that first quarter of a post-election year is like the third or second worst, because it isn't about red or blue or any of that stuff. Usually rally after the election just because, okay, whew, boy, glad that's over. And then you get some weakness early. We were on record at the start of this year saying a 12 to 15% gain in stocks this year. We're overweight equities, but the first half could see, potentially upwards of a 15% correction because we hadn't had one in well over 2 years. Well, we had a little more than 15, but honestly, it's what happened. And, I'm proud of the way our team kind of navigated it, didn't freak out, never lowered our guidance, never cut stuff. We managed almost $5 billion. We weren't cutting stuff. We said this is abnormal what's happening, but we think we're going to come back because it didn't make a lot of sense. The fundamentals are still solid. And fortunately, well, we've come back.
I want to read a comment from Widge, who's a regular viewer, is becoming a good friend of ours. Says, I keep waiting for housing weakness to help the inflation prints, but it just hasn't happened yet. Meanwhile, the easy comps for oil are winding down. Electricity prices are going against us. Just looking for general comments, obviously.
Well, can I start with that? Because the CPI we just saw, the
Right.
2.9 or was it 2.7% headline number, that largely reflected some of the Iran-Israel conflict in June that spiked oil prices. I know just for a couple of days, but they spiked and then they came back, but they came back at a little bit of an elevated level. That's the way you guys read that as well. And that's what I'm sure we're just kind of referring to, right? Yeah. So
yeah, no, that is the way I read it. And also, there was an expected drop in used car prices that didn't happen. But also you have, if you look at the weekly Manheim used cars numbers, they're ramping up. They're not coming down. So I don't know why anybody expected used car prices to come down, but I haven't seen it in housing yet either, except around me. Around me, I've been seeing it. Prices have been coming down in that sort of mid to high range, not luxury, not necessarily low. Tim can speak to that a little bit.
But that's
But
exactly
even
where
now
it
they
should
feel like-
begin, Bobby, right? A very,
Yeah.
very high demand area. That's the tip of the
Yeah,
spear.
this
Maybe.
place went nuts during COVID, and it's moving back, regressing back to its moving average, I would say. Right? I had a realtor friend. It's actually not a realtor friend of mine, but a friend of a friend show me a chart of the growth where I live. We were still this far off the typical trend line of that area, and there was still a decent amount to pull back before you would get back to normal price growth in this area. And I don't know that it ever will. But I'm just not sure that housing is doing that. And honestly, it's above my pay grade to know why.
So I'll chime in on energy and electric. Just reading literally a tweet from Sonu Varghese on our team. He really dives into this stuff. He said, September is not a lock. And he's got that little smiley face guy kind of thinking a little bit. Some concerns. He said electric utilities, so energy services, the last 3 months up 12% annualized, up 7.7 in the last 12 months. And then full service restaurants, which we really like to see because there's a lot that goes into full service restaurants. Last 3 months up 5.8% annualized, and the last 12 months up over 4%. So, yeah, I mean, we talked before. I think inflation's okay, but there are some troubling spots, and that what we're paying for electricity, it is offsetting potentially paying less to fill up your car for sure.
I can speak to full service restaurants. Yeah, the amount
Yes,
of,
you can.
The,
Good call.
The amount of costs we've seen over the last 3 years, we estimate that our costs are probably up 40 to 45% in 3.5 years. Is it almost 4 years now? It is absolutely staggering. We've only raised our prices 20%. We're in a little bit of a different situation than many are at our restaurant. Brant's a Palatine for people who are wondering. But that's all I had on that. Bobby, what do you got? Yeah.
I want to throw up Steve Goldstraw's comment in here. He said, so taxes are inflationary. Now, Steve is a bit of a ball breaker here and there, but I want to make sure that I clarify what I said based on that is they can't be inflationary and a tax. So what was driving me crazy was when the media on both sides were saying, it's tax on the poor, but it's also inflationary. It's not both. It can't be both. Either the corporations eat it, right? In which case it is not inflationary, or they pass it on to the consumer where it's a tax and it's deflationary. because money is not there to spend on other things. So aggregate demand goes down. So that's what I meant
I'm
by
just
that.
going to add to that real quick, but then I have a question for Ryan as well.
Real quick, Steve just put up, that was sarcasm. But
oh, yeah, we know it's sarcasm now.
Yeah, we knew it was.
The idiots who believe in modern monetary theory, they're the ones that say you fight inflation by raising taxes. You identify quickly and you raise taxes to pull liquidity out of the system. They're the same people that saying that the tariffs are inflationary. And they're the same people also who say that if you raise corporate taxes, they won't pass it on to the consumer. But if you raise input costs through tariffs, they will pass it on to the consumer. So every one of their arguments completely falls apart. That's just what I'll say about that. Which, by the way, later in the show, I want to get to the point that the Fed is actually easing slightly right now. And I will make that point in a little bit. But I want to ask you to split up some sectors for us, Ryan. We talked about on the Tradier Rundown before this show, we talked about how banks have been this quiet, not leader necessarily. Tech is still the leader, but the riding shotgun in this rally has been the banks. What sectors are you looking at for the next thrust or to lead the next thrust?
Yeah, we do like financials a lot. Financials and industrials are probably two of our favorites because our base case, again, is there's no recession coming. Economy might be slowing a little bit, but we'll see with earnings. I think we're gonna have another good earnings season. So those are two groups we like a lot. Now I'll tell you, with the money we run, we do things something a little more unique for listeners. Like momentum, right? There's those momentum ETFs, those factor-based ETFs. We actually did like we call like a pair trade back in November. Maybe it's right after the election, probably right after the election. We did low vol, about 5% low vol, about 5% in momentum. And I'll tell you, that has worked really, really well. Look, year to date momentum, I don't know what it's up right now, but well, but double digits. And yet low vol is outperforming the S&P 500 as well. So those are some areas we've liked momentum a long time. We think that works and should continue to work, but it's purely on sectors, industrials, financials, overweight. We've had between a 3 and 4% allocation to gold. I know we came on with you guys a long time ago talking about gold. And I believe, Jimmy, you liked gold a long time ago too, like us. And gold's done really well. Look at gold right now. It's just going sideways. It's just consolidating. I mean, gold was up 26% the first 6 months of the year. That's like, I think, the second best start to year ever, somewhere in the early 80s. Maybe it catches its breath for 6 months. Perfectly normal. But we're actually talking in our shop. I could give a little secret away. Some of our strategic models, and when I say the word strategic, we're talking 3 to 5 years. These are trades we're going to put on for 3 to 5 years. We're talking about maybe adding a little bit of gold because I think gold's in a major structural bull market. Doesn't mean I'm some perma bear. If anyone knows me, that's the last thing anyone ever calls me. But we've had some gold in there. So one big theme of ours, when we manage the money that we manage, we say diversify your diversifiers. This year, in fact, we were like 91% beta, the last couple of years. Coming into this year, we've been really overweight. Not a shock. People follow me and Carson Group. That's how we've been. We've been in the U.S. too. We've liked the U.S. Well, this year we're still overweight equities. Yes, our beta is back to maybe 70% now. We're going to cash register a little bit here because again, we thought the first half of this year might be kind of choppy, but we've gone more into developed international, right? I know, everyone loves Europe now. We were doing that back in February and March. Okay, we saw the fiscal stimulus that Germany was doing with defense spending. And that conversation I had a little bit ago about, deficits can be potentially a good thing when they're financed by defense or financed by taxes. Well, we thought something's different happening in Europe, and some more spending on the defense side of things could be the thing to spark their economy or at least their stock market. Clearly that's happened. So we're more even weight U.S. relative to developed international, specifically Europe, but we weren't that way at the start of this year. Now I will say small caps have kicked us in the a couple times currently because we were a little overweight small caps last year or so. Our theme of a little bit higher interest rates, we are back to overweight large caps relative to small caps for the remainder of this year. But trust me, we have some small and mid cap exposure, but we just think large will do a little better as rates stay a little higher.
So let's take a quick time out. It is halfway through the show. This is our time where I want to make the pitch to you guys. Luis, will you run the banner? We love all the people that have supported us on this show. If you truly want to support us a little bit further, please scan that QR code and try 3 months free of Tradier Pro's options trading platform. We know sophisticated options traders down to beginners who absolutely love this platform and can't trade the options without it. So please give it a shot. Just scan that QR code. No obligation. 3 months free. We very much appreciate it. Bobby?
Yeah, I want to put up another couple of comments that we got here. Number one is from our buddy Remo at Stock Charts. He said April 4th, 2025, S&P dropped 6%. 5 days later, gained 9.5%. Timing the market is hard. I think that's kind of most of Ryan's theme, right?
Yeah, let me tell you, that's a great point. So in 2 days, the S&P 500 fell 10.5%. Those 2 days after Liberation Day, whatever exactly the date was, I'm not sure, but down 10.5%. And one thing, I shared the chart a ton. We're not trying to time the market. By no means the way that I manage money, and we're an RIA, right? We're a $42 billion RIA. We're not trying to make short-term trades, but we're tactical. We make decisions like this. And the thing I shared, the worst days of the year, or the worst two-day returns, 3-day returns, you know when they tend to happen? Right around the best of the year. So again, what we were telling our advisors and their clients was, yeah, we just dropped 10.5% in 2 days. If you panic and sell right now, there's an extremely above average chance sooner than later you're going to miss literally the best days of the year. And that's exactly what happened. I use this example, 1997. 1997, S&P gained 30%. You guys probably remember it. You were back there doing your thing back then. There was one day, I think in August or September, S&P fell 6%. Imagine fell 6% right now, how everybody would just freak out. But back then, it still gained 30%. Okay, so you can have bad days, bad weeks, and it can still have a good year. And that's clearly what I think we're happening this year.
Oh, Bobby, can I take another quick time out? I want it because it's thundering out. So the two mutts are now, they have to be next to me. So the rest of the show is going to be done with Charlie on my lap. Again, Charlie's been lived outside for the last year down in Texas. She is a true stray that we just got a couple weeks ago. And by the way, if you guys are interested, and not you guys here, but anyone else interested in being part of Chicagoland Lab Rescue, it is an absolutely fantastic organization that brought us Charlie, who will be in contact with me for the rest of the show. Anyway, that's it. If I seemed a little distracted for a second, it's because I have 2 dogs crawling on me because of the thunder. But anyway.
Yeah. Well, I joke, I'm on TV all the time. I've got 140-pound Great Pyrenees, like within touching distance. That dog's been on TV more than anybody you know. Maybe your dog's been on TV with you too, when they're just down there sleeping. My big boy, until he barks, he's never barked. I've been on TV, I'm not kidding, probably 100 times. A big fat ass dog sitting right next to me. He's never barked yet. When he does, he stops. But for now,
actually, my place in Chicago was just this big raw loft, concrete floors, open ceilings, and a friend of mine had recorded a music video there. And I'm like, well, I still got to work, so you can set it up and everything. And while I was working, my dog was running around. It was my little pit bull rescue, Daisy. And when I'm like, all right, let me take her out of here. Like, can we keep her in the shoot? So there is a video shoot on YouTube of a guy singing, guy who was on The Voice. He did his music video. My dog's running around the background in my old place. That was pretty cool.
Okay. All right. Can I get to my thesis about the Fed is actually easing right now, whether people know it or not?
Please.
Okay, so the Fed's balance sheet, the Fed instituted quantitative tightening, I would say about 2.5 years ago, whatever. And they've been trying to run down their balance sheet. Part of running down their balance sheet is to let it roll off, which is the equivalent of selling bonds. Okay. They were selling bonds at a tune of about $90 billion a month. That number's gone down to about $5 billion. Now they're still selling bonds, but way, way less and draining their balance sheet way less than the market anticipated. In my mind, if that's not an ease, it's at least a cousin of an ease, less tightening than they thought. At the same time, M2 money supply is going through the roof. My argument here to you, Ryan, is this is, again, has some of the characteristics of a liquidity trade, could carry us the next wave higher. Do you at Carson Group look at that?
Oh, we look at all those things. Yeah, we do. I can't disagree with what you're saying. I mean, I think the easiest way to ease is they could just cut a little bit, but there are some ways around it. Now, let's not one other angle on this. We know the Fed's in a tough spot. We get all the stuff that's all over TV. Assuming Powell makes it to Jackson Hole, who knows? Jackson Hole has been this interesting time in late August where some real big policy changes, like you mentioned QE. I mean, like QE2, QE3 were all announced at Jackson Hole. I'm pretty sure. We've seen Operation Twist, for those of us that have some gray hairs. Remember that one? And a lot of these started at Jackson Hole. So I have no idea, right, if they're going to say something. But I mean, there's so much pressure on the Fed right now. Maybe they don't want to cut. Maybe they come up with some other angle we're not even thinking about with Jackson Hole out there. I wouldn't be shocked. And then again, just look at, keep it real simple, right? Look at yesterday's CPI, peel back that onion. I mentioned it already, but prices are down pretty significantly. I had it here. Maybe I've got it in front of me. Honestly, give me 1 second. I might have it here. Yeah. Okay. Yeah, here we go. Good. Airlines. down 3 months in a row, down 21% annualized. Airline fares down 21% annualized the last 3 months. Hotels down 4 months in a row. The last 3 months annualized down 15%. I mean, those are just two examples. Take it with a grain of salt. But that's saying I think there's a little bit of weakness out there. Look at the numbers in Vegas. Now, Vegas, hey, you can gamble on your phone. You can do things. Maybe you don't need to go to Vegas like you used to. But there is some softness, guys, and maybe the Fed should be thinking about easing. And we've been saying that all year, to be honest.
Tim, Robbie,
I'm just looking at ASML down. Looks like it's over 8% right now.
Why did they report it today?
Yeah, and actually, Luis, let's put up the ASML comment. I think it was at Stock Charts. ASML news today, not guaranteeing growth in 2026. I'm guessing he's asking, are they eating the tariffs? I'm going to guess that they wouldn't make that comment and say it was because they're eating the tariffs, because who knows if the tariffs will even be there by August 1st. We don't know. And that's one of the things I was watching. Somebody today, I wish I could remember who it was, came on Bloomberg, analyst, CEO of a company, I believe. He said that they had planned for the tariffs to be manageable. He said, because we remember how it went in Trump's first term, and there was a lot of rhetoric, and a lot of that rhetoric did not add up to the actual facts of the situation.
Yep.
And we planned it, and we planned it well. And now we're doing well because we planned for the tariffs to be manageable, and they are manageable for us right now. So I thought that was a pretty good way of looking at it. I want to throw up Tim's comment real quick. Tim says, Ryan is right on banks. The regionals will be decreasing reserves for CRE issues this quarter and for the next few quarters. Tim is in CRE, Ryan, just so you know.
Okay.
So we like as far as banks go, Ryan, you like regionals or the big protected, Janet Yellen will protect you if you matter. If you don't, you can go through.
Yeah, I'd say, well, the big ones. I mean, we're more in because like I said, we're not too warm and fuzzy about small caps. But yeah, the big banks, I know so far their earnings were hit or miss. It's very early. But the reality, again, there's been a lot of relative strength, as you guys, I'm sure, have talked about. So those big banks are still solid. I mean, listen, if you don't see a recession coming, I know it sounds like a broken record. We don't. Those are some cyclical areas we'd still rather be a little overweight in. And honestly, I mean, financials was probably our favorite sector last year, and it gained like 30%. I know this year's doing pretty good. So we're still riding that train.
Can we talk about Bitcoin?
Yeah.
What do you think about Bitcoin?
Yeah, I wish I bought more a long time ago.
I took most of my net worth and bought it at 11 cents a coin. Back in, no, I did not do that. But I have been.
You'd have like 7 more broken noses because you would say whatever you want. You would just talk. You would talk. You know what, to anybody if you were worth that much money.
I'd have to have big guys next to me. They'd have to slip in a punch, right? But so Bitcoin to me, I thought last week when it traded 110. 500 was breaking out of a technical pattern, and it did, and it's screamed higher. Do you believe it's do you think it's something worth investing in, whatever the hell investing means, over the next 5 to 10 years? Do you believe in an allocation for Bitcoin?
Yeah, well, it's kind of a gray answer I'm about to give you just because I live in a rural. Someone's upstairs banging. I don't know if that's a sign, but some loud noise upstairs all of a sudden about Bitcoin here. No, the reality though is there's a place for it, right? I mean, there is. Like, we manage a lot of money. We actually recently added an ETF that had a little bit of Bitcoin exposure. By no means are we saying put 10%, 20% into it, but I think people are realizing there is something here, and it's not really what we thought it was. I mean, it's really just an investment vehicle that kind of trades like tech stocks, just on steroids, right? I know most people know this. And then you look around with Ethereum. I mean, Ethereum, again, this stuff's above my pay grade, but I mean, it struggled for a long time. All of a sudden, it's taking a lot of relative strength. You got some really smart people talking about Ethereum as playing catch up. Those are kind of the Red Sox and Yankees. I'm not that smart. I would just say, if you like the area, buy some of the blue chips, and those are 2 of the blue chips in that area, and you can benefit. And the other example I give, just because I live in a world with working with clients, I mean, the internet, we knew it was going to be big, but remember Amazon.com, it was and this one was called .com. Jeff Bezos, man of the year 99. The stock dropped 86% the next couple of years into the lows, right? Bitcoin, I think it's 6 times at a 75% decline, at least 75%. So these things are volatile. If you're going to get in it, you can wake up one day and literally it's down 20% because they've had a heck of a run. We're going to have another one of those days, and usually it's on the weekend. It's usually on the weekend. I don't know if that's conspiracy theory or not. But for whatever, and believe me, Bitcoin you can sell on the weekend. I get it, but still a little more news heavy in the weekend. So I think there's a place in the younger person's portfolio, I think, to diversify into some of those areas.
Bobby, can you answer that question too? And the reason I asked, by the way, too, is I planned on putting like 1% of my investable in Bitcoin, and it started like 7, 8 years ago. Well, guess what's happened? It's now it's like 3.5%, and I'm like, shit. Now it's money that I have to worry about, So I don't even, and I've never sold any because I don't want to have a tax event on that. Bobby, what do you? I mean, I know you don't advise people on investments, but yes, we do. We have friends calling us all the time. What do you think, Bobby?
I tell people they need to own Bitcoin, but I also tell them to own it with the knowledge that it's either going to 0 or 1 million.
Yep.
And I don't think the idea of Bitcoin going to 0, I don't think that's a 0% probability.
I don't either.
That's why I really, for a lot of people, I'm going to be 59. So the people I talk to are in my age range. I think gold is better for the purposes because it isn't correlated to the NASDAQ, number one. Number two, it ain't going to 0. I believe that's a 0% probability that gold is going to 0. And I still think gold is the only thing that is both a currency and an asset. I think it's the only thing that exists that way. I can give a guy a gold coin. Now, I could give, if I have a guy who's fixing my screen in the back and he happens to be a cryptocurrency enthusiast, he'd be, you could transfer me Ripple. I don't care. Sure, that can happen. But I know that I can drive 5 minutes from here, trade in a coin, take that money and go to the grocery store. As a matter of fact, funny thing, Florida, where I live, they just officially, legally made gold and silver legal tender. I took a Golden Eagle coin worth what's it worth right now? About $3,300, $3,200. I went to a Publix grocery store and bought a can of soda and tried to give it to them. They wouldn't take it. So it's maybe I'm full of shit when I say that it's actually a currency, but to me, at its core, it's a currency and an asset. But I believe Bitcoin is an asset. I just don't think there's any assets out there right now, regardless of what the cultists say, that you're not thinking of it in converting it to fiat. So Bitcoin has to lose that before it's the thing to me. But I do think it's an asset, right? I do think it's something that people should be invested in because there's just too many big names involved in it now for it to completely go away tomorrow.
Well, that's why I broadened my position in it, was because of the institutional adoption. And I think that was a viable thesis too. When second BlackRock starts talking about getting into something, I want to get into that asset. Before Ryan, you mentioned industrials. So what about industrial metals that go along with that as a corollary? Copper, palladium, platinum. Some of them have had really astronomical runs. Do you think that those runs continue?
Yeah, we do. I mean, the short answer is we do. We've got some managed futures, which obviously are kind of trend following mechanisms when it comes to commodities as well, that if commodities keep going higher, we should do pretty well. And I guess like just from a big picture point of view, you look at gold. I mean, most of us probably remember 99 gold bottom, I think at 240 or 260 an ounce, and then it went up like 12 years in a row. Then for about 12 years, gold literally went nowhere. Well, gold started going higher again in 2023. All right. And you have to ask yourself, will it go higher for 12 years again? I don't know. But I do know these cycles last a lot longer than you think. And then you look around and copper just broke out. And I get it. President Trump said the 50% tariff thing. That kind of, I don't know, as an old school trader, I kind of hate breakouts on news. So me too. That, I mean,
Bobby and I, we've discussed it. I hated it.
That's like reeking of at least a, not generational top, but like a intermediate term top. Like, oh boy, and it's at the top of the range. My buddy Chris Kimball shares a lot of cool charts. He's got copper at the top of range on news. So anyway, but still, yes, those industrial metals, again, it's that theme. I sound like a broken record, but if the economy is a little bit better than people think, I mean, listen, nobody trusts Chinese data. I don't, you don't, no listeners should totally trust it. They just said their GDP was 5.2%. They just said we're actually selling a lot of exports. I mean, China's selling a lot of exports. Yeah, we're not buying as much, but everybody else is buying stuff from China. So listen, China is going to gobble this stuff up. They're creating more cars than they're making like no cars this time 5 years ago. They're making like 7 million cars a year. I mean, they are buying a lot of this stuff. The U.S. is okay. And honestly, 7 months ago, when nobody wanted to touch Europe because it underperformed the U.S. for 16 years in a row, to be honest, myself included, our shop included, until they started changing their fiscal policy around February. The reality is U.S. supposed to grow 3% this year. developed international, Europe, 0, virtually flat. Well, now it's like we're both going to grow maybe between 1.5% and 2%. So it's like it's all about these expectations. But again, Europe's finally doing a little bit better as well, we think. So all this stuff says those industrial metals are they make sense. And to put a bow on this, when in doubt, diversify it out. It really makes sense not to be so overweight U.S. stocks like we've been the last couple of years. We still like them, don't get me wrong, but there's a lot of other areas that make sense as this economic cycle ages. And I'm an old school John Murphy guy. I have a CMT behind my name. John Murphy used to say message of the markets. You look at an economic cycle of growth, the last couple of years, what does best? Energy, commodities, some of those things. I'm not sure if we're at the end of the cycle. I'm just saying there's still time, right? It's when you start to see energy really doing well, that's when you gotta look around and say, okay, we might be near the end of this cycle. 2006, 2007, what was the one group really doing well? It was energy. All right. I mean, we've seen this in these cycles before. We're not there yet. Energy's not doing much now, but I think energy and commodities, they probably still have some more life to them here in terms of upside.
One of the things I've always liked about you, Ryan, is that you have the same sort of attitude that Jimmy and I have, where we can have all the opinions in the world, but the only thing we know for sure is that Cleveland Cliffs, the high today was $9.21. I mean, the only thing you know for sure is the price. And that's the only thing we know as a fact. And the rest we're trying to not guess on, but they're educated guesses. Jimmy, we got a lot of questions here. Unfortunately, guys, I'm not going to put up your comments simply because we're running out of time. And I want to make sure Jimmy gets his last question in. But Luis, this one's going to be hard for you. But Dan asks, how much longer till the big institutions start piling into the gold silver miners? I don't know that they will. You go ahead, Ryan.
Ryan's wondering who Brian is.
Oh, I said Brian. I said Ryan.
You said Ryan. Okay. Yeah, we're getting older.
So the question for me is, when will the big boys go in the gold? I don't know if they will either. I don't know. I mean,
well, he's talking about miners. I mean, that's why I think the lesson may be learned that if you're bullish gold, you buy gold, not gold miners.
That's what we've done. I mean, in our shop, that's what we did. We did that.
Can I add to this? Because Dan, if I didn't get busy today after the PPI number with my clients, on my list was to start charting out some of the silver miners that have very much underperformed. I agree with Bobby, and generally speaking, that if you want to own silver, you own silver, but that doesn't mean there isn't some good value in those as well. So I'm going to be writing some stuff about those tomorrow, and I'll send it out if you're interested, Dan.
We got another question here from Widge. Mentioned earlier was hotels and air traffic. To what degree should we have expected the appearance of weakness with the reversal of immigration that seems to be picking up as the year moves along?
I'm not sure I mean, what I was talking about was prices of the underlying CPI on airfares and hotels and things. So again, I don't know if that's impacted so much by the immigration policies. I mean, clearly we know when you look at the jobs number, Jimmy mentioned the jobs number, and it was weakish, but it's better than expected. I mean, we are seeing some of the issues that are happening with some of the immigration policies with our overall growth as it pertains to the economy. One thing, though, is a lot of immigration is slowing down. Well, we don't need 150,000 jobs to grow on trend anymore. We think our shop thinks it's more like 110,000 jobs to grow on trend as this economic cycle ages. You don't need as many jobs. At the same time, you know, there's some interesting thoughts there, I guess. I'll just put it like that. I want to go too down that rabbit hole. Yeah.
Last question. The rest are all comments. Steve is really angry at Bitcoin, but Remo says, will quantum computing AI make blockchain obsolete? I have a comment on that, but go ahead, Ryan, if you have.
I really don't know that one, guys. That's
all right.
Yeah, I don't want to say anything on that one. I'm not sure.
Here's another reason why I like both Bitcoin and gold, but I like gold better. Is in the case of, let's say the government says, fine, you guys do the currency. Go ahead. You know, the American government says, we don't care anymore. We're disbanding the Fed. Bitcoin's the currency. That's it. We're done, which I can't ever see them doing. Number one, what do you think the percentages of people that have their Bitcoin in a cold wallet versus online somewhere where quantum computing can break the key and steal it from them? I think as quantum computing gets better and better, it's going to break the cryptography that cryptocurrency is named after. And there's going to be a lot stolen,
But won't the cryptography get better and better using the same quantum computing?
Possibly, but you're talking about like the faster rabbit, right? I mean, like before that happens, a lot's going to be stolen. right?
Yeah.
There's going to be a lot of people who are going to be like, nope, want my money in my pocket. I had 5 million stolen. And that's what worries me about that. You know, it worries me
I think it's
tremendously
a valid
about
worry.
the electronic side of it.
Yeah.
It's because any time something is electronic, there's a possibility it gets stolen, period.
Sure. Yeah,
The only time if you have a cold wallet. If you have a cold wallet, it can't get stolen. But you still have to either meet up with the person you're exchanging Bitcoin with and plug the two cold wallets together, or you still have to go online to do it.
Sounds kind of sexual, doesn't it?
A little bit, yeah.
Sorry,
so
Ryan.
that's my feeling on that.
So why don't you read the comments and then I'll play out?
Yeah, quantum computing is my biggest risk to blockchain, other than a government just coming in and saying whatever Trump and the last 3 administrations said, we don't agree, Bitcoin's illegal.
Okay, and they could do that. China did it, and what happened? Bitcoin mining increased, not decreased.
Right. Yeah. Becomes the black market money that everybody says it really is, which right now it's not.
Any comment that you need to say before I play us out? Robert? Oh, you're looking.
No, I'm good.
Ryan, where can people find you?
Yeah, at Ryan Dietrich on Twitter, and then also carsongroup.com/research is our blog. And then I'm also well known, I guess, anymore because of our podcast, Facts versus Feelings. Or get your favorite podcast, do that with Sonu Varghese on our team. Talk about literally all the stuff you and I we just talked about.
It's
every
a
Wednesday.
Great podcast too, by the way. I can attest to that. It's amazing, and you guys should all give it a go. Thanks so much. We have to go, Bobby. Is there any comments that really jump out at you or no?
Bitcoin is a slot machine, according to Steven.
It could be. Yeah. I'm not even arguing against that, Steven. It might be.
Here's
I don't know
one
what the
more.
hell it is.
BlackRock is Satan.
Exactly my point, Steven.
Steven was just on fire today.
He's on fire.
There's a comment from Jim Iuorio. Google is the CIA.
Google is the CIA. I've been arguing this for 5 years as soon as it dawned on me. Of course, the CIA is going to let an institution exist that collects intel on people better than they do. It would never happen. It would never happen. Of course, Google's the CIA. That's why I own the stock, and it's been a good stock.
Ryan, I'm sorry you had to witness this.
Someday there's going to be a sniper, just a bullet. You guys are going to see it live. Just come and take me out. He's talking too much. Anyway, this is The Trader's Edge. I'm Jim Iuorio. That's Bob Iaccino. Of course, Ryan Dietrich, one of our favorite guys who always puts the calm in us when we think things are falling apart, and we can't say how much we appreciate that. It's just amazing. Thank you guys for all the DMs, all the retweets. We appreciate it a ton. This is The Trader's Edge.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.